Thank you, Zoe. Well, first of all, thank you for having me here. Honestly, it's amazing how quickly time goes by. It feels like I was just in your seats, not too long ago, but actually it was about over 15 years ago. So that's dating myself. But like Zoe said, I'm investment focused on hotel acquisitions across the U.S. We generally employ a value-add strategy, whether that's in property management, up-branding, rebranding, and just looking to see how we can kind of create value. So today I'm gonna walk you through kind of what my career journey has been to date. What are some lessons learned? What are some tips and advice that work for me? Maybe it'll work for you. And then I'll pivot over to the hotel industry as to why I've decided to kind of focus on the hotel space. I kind of started my career off very broad at a large company, and then over time I kind of started a niche. Once I kind of started figuring out what it is that I really enjoyed doing, because I didn't come from the real estate, I don't have a real estate background in terms of from my family, and it took me a little bit of time to try to figure out what it is I wanted to do, and so that was kind of like what really worked for me. So we'll go ahead and kick it off. So here, I've always been a big fan. As Zoe kind of mentioned, my background, I've done a couple of graduate programs. I've always been a big fan of continuous education, learning, just being a sponge, and always trying to, every so many years, just kind of taking a step back and just see, how can I kind of come back into what I do with a fresh perspective. How can I kind of add another tool to my toolkit, and just learning from what other people have done, from other walks of life. And like I mentioned, I've seen some folks that have kind of chosen to kind of niche too early in their career, and it makes it difficult to pivot later. And so there are some folks who maybe they grew up in the real estate development industry, or they grew up in the financial advisory industry, and they know kind of what they want to do. That wasn't the case for me. So starting off with a big company, starting off broad, and then starting to niche and go to a smaller company later in my career, that's what made sense for me. So here, this is kind of really just like a timeline of my career to date, starting from '96 when I went into undergrad to kind of current time period. So, Zoe mentioned, my undergrad, I went, from '96 to 2000, played tennis all 4 years, studied finance and engineering. Kind of like the son of most doctors, I went down the path of initially pre-med, and then I pivoted about 1.5 years into undergrad, which meant I had to overdo it on the number of credits I took to still finish in 4 years. And so once I came out of it and I was getting close to graduating, I knew I wanted to get into finance. I wasn't sure exactly what area, but I wanted to work up north, I wanted to work on Wall Street. I wanted to do investment banking, private equity, equity research. I wasn't 100% sure. So I didn't have a lot of those type of firms come down to our campus to interview. So what worked for me is I printed about 150 resumes, had the one suit that I had, and went up to New York, slept on my best friend's sister's couch, and just went and knocked on doors. I got kicked out of a lot of office buildings, because I didn't have an appointment. Tried to find out as many HR contacts, that I could online, just through contacts of contacts, and just try to get a way in. And so I handed out all 150 resumes, translated to 5 interviews, 3 Super Saturday interviews, which is like the final round interviews in the investment banking world, and that translated into 2 offers. So GE Capital was one of them. I started off in their financial management program. It's a 2.5-year program, 6 months, 5 rotations. Really, they parachute you in every 6 months into a different rotation. It could be a different location, different GE Capital business, and just a different area of finance. While you're doing that, you're also taking MBA level courses during that. So the idea is like every rotation, you're learning how to adapt and how to hit the ground running a lot faster and how to add value quicker than you did in the previous rotation. So I ended up spending about 6 years with GE Capital. Started off as an analyst, had the opportunity to move into risk management in Europe for a couple of years, and then on the business development side in California. After about 6 years, there was an opportunity that came to me, which was a startup company based out of Boston. they were in the sponsor finance segment where they provided equity and debt to private equity companies that were looking to acquire portfolio companies. And so they brought on myself, another person from GE Capital, and a person from Bank of America Securities. So it was a good assemblage of backgrounds, and it was just a unique experience that I couldn't get at GE Capital, being with a startup company that had already expressed an interest to go public. So when I joined, we had just filed our S1. I got to be part of that process, which was really interesting. We successfully went public in November 2006. That was a very frothy time in the public markets. A lot of specialty finance companies had gone public. Up until that point, I'd been working for a little over 6 years now. I was a generalist, covering a lot of different industries, and I felt it was a good time to start to pick an industry. What did I enjoy the most? And so that's where it kind of brought me to University of Florida, ultimately, to do the MSRE program. I decided that real estate is what I wanted to focus on. I looked at a lot of different programs. As I started researching the different programs, I started realizing a lot of these programs all are very much relationship driven in terms of where you ultimately kind of are able to find opportunities, because real estate is a relationship business at the end of the day. And I looked at University of Florida, a very highly ranked program at the time. This was 2007 to 2008 when I did the program. And I saw myself also being able to live in the Southeast. I never lived or worked down here, so I was definitely taking a little bit of a leap of faith. The other thing that really attracted me to the MSRE program was how open the administration was in terms of allowing me to speak to advisory board members and the alumni. And so that just gave me a sense of, while I'm in the program, that the doors will always be open. And from a networking standpoint, and again, you'll hear throughout this presentation the idea of a relationship. Relationships matter. And the way I kind of navigated through the program was I just got in the car and I got out and met people. I think in my car over a 10-month period, I probably traveled about between 10 to 15,000 miles, just getting out and meeting as many board members as possible. So when the time came during the Trends Conference that I had to get up and do that 2-minute spiel, I'm looking out in the audience and I could say that honestly I know 75% of the people. And then at that conference, it was the second time meeting them. And then in the spring, I got back out again and met them for a third time. So when opportunities came, I wanted to be kind of front and center. And it wasn't a great time in the economy because it was a great recession. It just got worse as I came out of the program. I was hoping I'd get to hide out in the program and it was going to be a lot better when I came out, but that wasn't the case. And you'll see here, as we kind of go through, you'll see all these names here. And that's been done on a purposeful. These are all people that are board members of the University of Florida, the real estate program. Every opportunity I've had since I've come, since I did the program has been directly because of the program. So the first opportunity I had was with a private investment group called Set Point Partners. It's an affiliate of the Swordlow Group. And I found that opportunity through Jim Freed, his board member. He called me up and said, "Hey, I got an opportunity I think you'd be a good fit for. When can you be down here?" I said, "I'm hopping in the car right now." And I came down, met, and some back and forth, and ended up getting an offer. And it was a very challenging time because again, it was a great recession. I think honestly, probably half my class is not in real estate, anymore. But those that did find an opportunity, it's been very sticky because I do think that in difficult markets and difficult, cycles of the market is when you learn the most. And if you can get projects done, you can get financing placed, you can raise equity capital in a down market, you can do it in an up market. And so I was there for about 2 years. Our focus was to acquire portfolios. There really weren't a lot of portfolio acquisition opportunities at that time because the government had backstopped all the banks. And so that disincentivized the banks for putting out portfolios. Instead, the opportunities were in individual loans to purchase, converting them to fee simple, recapitalizing existing owner-operators that had over-levered their properties, and really being able to close in an all-cash manner. And so that wasn't what we were interested in doing as Swordlow, so I had started to look for another opportunity. And so you see Rachel Ween's name right here, so DeBartolo Development, she introduced me to them, and she said, they're looking for an acquisitions person. Ideally, your background seems to be a perfect fit. Would you be interested in going out there? So hopped in the car, went and met them, spent a week with them, and ended up spending the next couple of years running acquisitions. We closed on about $500 million of distressed acquisitions across retail, grocery big box anchor retail, Class A multifamily, and limited select service hospitality. And in each of these, we partnered with local operators. And so you'll see there'll be a tie-in to my time at DeBartolo to what I'm doing now. So during the course of being at DeBartolo, over time, around 2013, 2014, you started to see cap rates started to compress. Valuation started to increase, but our cost of capital stayed about the same. So our deal velocity naturally dropped. And during this time, another board member, Edgar Jones, who's become a good friend of mine now, each of these people I've met, they were mentors of mine in the program, and now they're colleagues and they're friends. And Edgar Jones said, you need to meet these guys, at Encore Capital Management. They're doing some interesting projects out in Miami, ground-up development projects in Florida and California, and they're raising a lot of money. So I came out, they had raised about $1 billion across, or just put the finishing touches on raising $1 billion across 3 investment buckets. And they were actively growing their assets under management by a pretty fast clip. But during this time, their headcount stayed the same, so that rubber band was getting stretched, pretty thin. So they needed someone that can wear a lot of different hats, and that was kind of my background coming out of the program. Is I was just tasked to wear as many hats as possible, from deal inception all the way to closing, to asset management, to ultimately monetizing. My first, it kind of started off being a jack of all trades, and then the opportunity kind of evolved into overseeing investments in capital markets. So I ended up staying there for about 6.5 years. I could have been there for the next 10 years. It was a great experience, a great group of individuals. And while I was there, I had the opportunity to kind of go back to grad school. And so very fortunate that they allowed me to do that. Part of it was in person, and the other time was remote. And it was over a 1-year period, an executive program. So after about 6.5 years, one of my JV operating partners when I was at DeBartolo, a group by the name of Banyan Investment Group, I was one of their first outside investment partners. We JV'd on a handful of investments. We really enjoyed working together. We stayed in touch over the years. And about 2.5 years ago, so call it about almost 11 years, almost 12 years after we first started working together, we had the opportunity to kind of bring the team back together again. And so I came on board to run investments. So as the chief investment officer, I oversee acquisitions, refinancings, how we structure our capital stack, dispositions. Really talk about how things kind of come full cycle, in this timeline. So Satori Collective is who I'm with right now. They're originally called Banyan Investment Group. The reason for their rebranding is we were historically vertically integrated, meaning everything we owned we managed, and everything we managed we owned. We wanted to split the property management company from the investment company and allow both to grow independently, separate P&Ls, separate leadership teams. And so now on the investment side, we rebranded the company from Banyan Investment Group to Satori Collective. This allows us to work with any third-party operator. It increases our deal flow exponentially. And historically, we never saw deals from third-party operators because they were always concerned, we have to manage it, so is there a place for them? Which that was never the case. But now what we've done with the rebranding is cements it in the industry, and now everyone understands that. And one of the 2 managing members of the company is someone that I went to undergrad with at the very beginning of the scale. And we've stayed in touch, anytime, if, for Kentucky basketball, we get together to watch the games, in Atlanta for the SEC tournament. And we've just stayed in touch to where our families have gotten to know each other, and now we have the opportunity to kind of work together. So this just kind of brings everything back full circle, and it really kind of just, I just wanted to illustrate the power of relationships and the importance of relationships. Doesn't matter how big the company is, how big the industry is, it's still very small. And credibility, how you conduct yourself, integrity, you never want to sacrifice on that, no matter what. It's not worth it. So in terms of things that I've learned to date, across that timeline from 96 to present day, is the only thing that's constant is change. You have to be willing to be a sponge, always be willing to learn, always be willing to be flexible and pivot when you need to. You can't just have a very singular line of focus and just expect no matter what the market cycle is, you're going to be able to do that. You got to be willing to be flexible. The other thing is communication. I would say both verbal and written, the importance of it. There's a reason we have 2 ears and 1 mouth. Listen first, speak second. Being able to, also take complicated concepts and distill them down in a very simplistic fashion is very important. That helps you when you're out there, whether you're marketing yourselves for an opportunity, if you're out there capital fundraising, if you're out there negotiating with lenders, being able to speak in a very simplistic manner, across complicated concepts. Also from a leadership standpoint, how do you inspire and motivate? How do you get people to kind of perform at their best? And it all comes down, from my perspective, for what can I do for you, not what can you do for me. And when I went out, to meet with advisory board members when I was in the program, I always offered, is there any type of research? Is there any case studies I can review? Is there anything that I can do for you? It was never going and saying, do you have a job for me? Because frankly, there weren't any jobs at that time. And if you can make yourself, where you come across as very humble, very fungible, a sponge, you're willing to learn, people will be willing to take a bet on you. And in terms of, just kind of bringing it all together in terms of, just what I kind of call career tips is, really the power of networking. Take advantage of everyone that you're sitting next to. These are all going to be your industry colleagues. You're going to be working on doing business together as you get more and more seasoned in your respective careers. Someone might be an appraiser, another one might be a lender, another one might be a developer. You're going to need all three to come together in order to get a particular project done. A lot of my mentors in the program have now become colleagues. It's just the importance of relationships and always being true to yourself, always being honest, always holding integrity, being transparent. If you make a mistake, it's okay. Raise your hand up, ask for help. Just don't make the mistake twice. That's kind of the kiss of death. That's the definition of insanity, doing the same thing over and over and expecting a different result. I talked about being a sponge, just being flexible, always willing to take in new knowledge. Doesn't matter if the person's older than you or younger than you can learn from everybody. And mentorship, whatever opportunity you take, make sure it's in a place that you're going to learn. Someone that's going to support you. You're going to have a good cast, a good team dynamics, where you're going to be able to learn. And as you get more seasoned, pay it forward. Come back to the university, speak to the students, always put your hand up, be willing to serve as a mentor, and always keep your door open. Because all the board members did it for me, I'm going to do it for each of you. And whatever you're doing, you always want to make sure you're learning. The minute you stop learning, that's when you start dying. That's when it's time for a change. And for me, like I said, I started off broad, and then I started narrowing my focus over time. Why did I select hospitality? It's really for a variety of reasons. I love traveling. I love staying at hotels. No two hotels are the same. It's very customer focused. I love just going to whether it's the hotel bar or if it's talking to the general manager and just talking to them. What makes their place unique and different, because they're the ones that have heard all the stories. They're the ones that see everything that happens. And, it's, again, very customer-centric. It's all about the customer. I think you have very high barriers to entry in the hospitality world. You can find people that invest in multifamily that may also invest in self-storage. People that invest in retail may also invest in office. But you don't find them also kind of jumping over into hospitality because it's a completely different beast. It's a true operating business. I like to compare it to if you own a retail center or if you own an office building, but you're also the operator of each of the individual businesses in each of those buildings. Because in a full-service hotel, you can have multiple food and beverage operations, you have meeting room space, event management, you may be catering to weddings, large groups, you may have like a cafe, you may have a retail store, you got a spa. Those are like 5 or 6 different businesses, plus you got the rooms. So that's 6 or 7 businesses within one building structure. So I know, there's always a lot of discussions, is hospitality, is it real estate? And it's both, it's real estate and it's an operating business. But what I like about it is that there's so many different levers you can pull. If you understand the hotel business, so many different levers you can pull in order to create value. You're not just stuck in a long-term contract and that's your rent, that you're collecting. Over a period of time, you gotta wait for the next escalation clause to kind of kick in. Here in a good market, in an inflationary environment that we're in today, in strong drive-to markets, you have the ability to reprice rooms daily. It's average daily rate. So historically, hotels have outperformed inflation by over 150 basis points. You also get the benefits of accelerated depreciation, bonus depreciation, because of all the fixtures that you have in the hotel. So, like one of our acquisitions that we made, almost 2 years ago, we're able to offset distributions for about 3 years worth of distributions because of the bonus and because of the depreciation aspect. You can't do that in other real estate asset classes. So going into like the different types of hotels, I kind of break it down into 4 types. You got the limited service, which is like your budget friendly. You don't have any amenities. It's like your Holiday Inn Express and your Hampton Inn. Then you've got the select service, where you're starting to get some amenities. You might have like one food and beverage. You might have like 1,000 square foot meeting room space. So this is like your Courtyard, your A-Loft under Marriott, what used to be Starwood. And then you got your extended stay. This is like your longer term stay. People can stay there for like 30 days at a time, or maybe like 2 weeks at a time. And this is kind of like a hybrid, like a shorter term stay versus multifamily. So examples would be like Homewood Suites, Residence Inn, Staybridge Suites, Extended Stay America, those type of hotels. And then your full service are those that you have a plethora of additional revenue line items in different businesses. So you'll have a spa, you'll have multiple F&B outlets, you'll have meeting room space, and you could have like a retail store, a coffee shop, etc. So this would be like your full service Hilton, your JW Marriott, some of the boutique properties like a Curio by Hilton, a Signia by Hilton, and those would be the ones that fall under this. The ones that we kind of really focus on is the limited service, select service, extended stay, and I will also say compact full service. Not like your convention style hotels, but basically full service hotels that have maybe like say 10,000 square feet of meeting room space or less. So just want to kind of pose a question, anyone can answer. How many hotel properties does Marriott have? Does anyone know? That's branded under their umbrella? Yes, what do you think?
About a few thousand.
So they have 8,500 properties globally. And of those, how many do you think that they actually physically own?
80%.
It's actually 25%. About 2,100 properties is what they own. So what happened? How's the other 75% capitalized and owned? It's by groups like Satori Collective. We engage in a franchise agreement with Marriott or Hilton. So we're the franchisee and they're the franchisor. So they collect a percentage of top line revenue, and then we manage everything inside the 4 walls, including we own the actual real estate in the dirt. And whatever that net cash flow that it spits out, that's for us. So that goes back to it's a true operating business. And you really have like 4 partners in every hotel acquisition. You've got your lender, so how are you going to get the debt? So really like how you're going to capitalize it, that's debt and equity. So the debt is your lender, the equity is your investors. Investors come in generally two forms. You got institutional and you got retail. And in between you got family office. Some family office groups behave more like institutional and others behave more like retail, depending on the size and scale of them. We've worked with both. We've worked with the institutional folks, but they've been largely on the sidelines for the last couple of years, so we pivoted to raising capital through retail channels. That's like high net worth investors, small and medium-sized family offices. So we basically have the ability to take down an acquisition, with our internally managed capital, and then we backfill it with retail capital post-close. It's a little bit like herding cats, because when you're dealing with an institution, it's a single check writer. When you're dealing with retail investors, it can be like hundreds of investors coming in. And then the other two partners, I mentioned there's 4 partners in every acquisition. The other 2 would be like your franchise, so that would be like Marriott, Hilton. The benefit why you pay them the percentage of revenue, as their fee is because you get access to their technology, their reservation system, their massive loyalty membership base, which helps drive revenue. And then the 4th would be the property operator. Sometimes that's internally, that's internally managed, and others it's working with a third-party operator. So in terms of, I kind of just put this out there, these are just like the steps, high level in acquiring a hotel. Initially, whenever we find out about an opportunity, we'll get either like a marketing book from a broker, or if we're dealing directly with the seller, we'll all get, maybe like the T12 financials, we'll get some property level reports, what's called a STAR report, Smith Travel Research. They're owned by CoStar. They provide comp set data and also specific property level top line performance data. So we'll get all that together, put together an initial pro forma, and see if it kind of hits, some of our initial criteria. And if it does, then we'll go and we'll actually go physically visit the property. We'll tour the submarket, evaluate all the comps, and see if there's any surprises, anything that wasn't disclosed to us that we can readily view. And then once we kind of go through that, we'll come back as a team, we'll revisit our underwriting, fine-tune it, and ideally get to a position that we can issue a letter of intent to acquire the property. If it's part of our brokerage process, there's other people also going through the same process. And so once we kind of have some guidance or some inkling that we're going to be able to move forward and we may get like a letter of intent accepted by the seller, we'll then start the process in structuring the capital stack. So that's like trying to find what will the debt look like, go out and start soliciting quotes from lenders, and also start putting more thought into how we're going to capitalize on the equity front. And during that time, during that process, if our letter of intent gets accepted, then we start the process of negotiating the purchase sale agreement. So that's just kind of blowing out the letter of intent and going through every step of, like what you're obligated, for both the buy and also for the buyer and also for the seller. Once we go through that, the typical time frame, once you negotiate the purchase sale agreement, is you'll have anywhere from 30 to 60 days for due diligence and then 30 days to close. And during your due diligence period, your deposit that you put up is fully refundable. So during that time period, you want to try to uncover all the hair, all the stuff that the seller doesn't want you to know about the property. You want to find that out. So we'll launch a bunch of third-party assessments, such as the property condition report, the environmental studies. Lender will commission the appraisal, and we'll go through, review all that, and assuming that there's no surprises that come up, there's always going to be surprises. Then we get to we start getting to the period where we're ready to go hard on our deposit. And prior to that, we already start the framework around identifying who's going to be our operator, whether it's going to be internally, through our affiliate, or if it's going to be through an external. And once we do that, we get them out to the property, because part of our due diligence is we want them to also vet the property, bring back to us I would say like an unbiased 5-year projected cash flow analysis without having the benefit of seeing what we did, so we can kind of compare and contrast and have that live discussion with them to really understand. Again, purpose of due diligence is to verify and validate everything that you assumed about the property and uncover any type of surprises, and how are you going to mitigate it. If you can't mitigate it, then maybe you walk away from the opportunity. And then once you've gone hard on your deposit, the focus is close. Get the lender ready to close on time, get the property management team back out on the property to start that transfer, that turnover period from the previous operator to who the new operator is going to be. Then ultimately we close, we high five, we celebrate, but then shortly thereafter, once the dust settles, we all huddle back up and just understand what went well in the process and what didn't go well. The idea is that this process is a live process and you're always trying to see how can you do it better, more efficiently and quicker. So that kind of concludes what I had to, what I wanted to kind of go over. I just wanted to kind of say before we get into Q&A, one of the things that was very beneficial for me when I was in the program is that the board members always had an open door policy with me and all of my classmates, and I want to reciprocate that. My contact information is right here. Feel free to reach out with any questions. If you're ever down in South Florida, please reach out. I'll be happy to take you out on a site visit, take you out for coffee, or if you ever want to just bounce ideas as you're evaluating opportunities, please use me as a resource. That's what I'm here for. The QR code also, hopefully that works. You can just kind of get my contact information that way as well. So with that said, I'll kind of open it up for Q&A. Yes.
How do you feel like the hospitality industry has reacted after COVID?
It's I can say like in our portfolio, as a result of COVID, with the lockdowns, our portfolio went from being in the high 60s occupancy to single digits overnight. That is something very difficult to deal with, and that creates opportunities to reevaluate, how you're operating the properties, how can you do it more efficiently. A lot of hotels kind of went to where cleaning your room daily, that's more by request than it being mandated. I think like post-COVID, sometimes if people are staying in their hotels just for 2 nights, they don't want someone coming into their room to clean it. There's more than enough towels and soap to carry for 2 days. I think the hotel industry has gotten, I think one of the things like pre-COVID is when you compare all the different asset classes, you always look at cap rates relative to interest rates. There was always historically a much bigger spread for hotels because it's higher on the risk spectrum, or on the spectrum of risk. Multifamily had a much tighter. We were building at Encore like a return on cost of like say 6.5%, and we're borrowing at around maybe like 4.5%. Hotels, you're doing it at a return on cost, north of 8 or 9%. Historically, cap rates have been like around between 7 and 9% for hotels, and debt was like around 4%. Post-COVID, or I should say pre-COVID, I could borrow at 65% at 3.5 to 4% interest. That's non-recourse. That same piece of debt today is 55 to 60% at, call it 500 over SOFR. So you're talking at least minimum 9%, as high as like 10%. So when you talk about your interest rate going up almost triple, 2.5 times, valuations haven't come down by that much. So there's been, last year was an extraordinary, lack of transaction activity that occurred. And so there's still room for valuations to come down, or rates have to come down, but no one wants to acquire properties and be in negative leverage. I would argue that other asset classes like multifamily have flipped negative leverage territory a lot more than hotels, because hotels already had that larger spread. So I just said that hotels have historically traded for between 7 and 9% cap rate. Interest rates now for cash flowing hotels are around like 8.5%, 8.5%. So you can still make acquisitions if there is some kind of value add strategy on in-place cash flow and not be in negative leverage, but it's pretty tight. But it's better than the other, in terms of other asset types. So it's, I think post-COVID, I think people are a lot more careful around leverage. It doesn't work as well for hotels as it does for other asset types. When you have longer term leases, it's more predictable. For hotels, there is that seasonality aspect. I think it's a lot of markets that are leisure driven. They become very strong drive-to markets. So some of the shoulder seasons that historically have been softer are now stronger because I think people, the way their vacation is a little different. They're not always reliant or always have to hop in a plane to go somewhere. They'll just hop in the car and go wherever's the closest vacation spot. So a lot of these drive-to markets, like places like Savannah, Hilton Head, many markets in Florida, have seen less seasonality during the course of the year. So hopefully that answers your question.
Can you repeat again what degree you got at the Harvard School of Design, and can you kind of explain why you decided to get an additional degree?
Sure, it's called the Advanced Management Development Program. It's a program that's geared towards generally the average work experience was people with about 15 years. I was just north of that. It was a very different kind of collection, very seasoned industry folks. Like for instance, in my class, there was a person that ran JLL for all of China. There was a person that there were folks that ran, like for the Abu Dhabi Investment Authority, was like the top guy over there. And just, people that have, very seasoned. And for me, where I was at Encore Capital Management, I was so entrenched in large ground-up development, mixed-use developments, with my head in the sand, just focused on that. So my networking and seeing what was happening in the outside world, that networking really kind of came to a standstill just because of the nature of the type of projects we're working on. And I wanted to get back out, network, take a step back, and just see, reevaluate like kind of what I was doing and how can I do it better, and just hear from what other people in my area of focus, what they're doing in other parts of the world, sharing best practices and just learning from what other people are doing. And so I did that, it was 1 year. Interesting story there. My wife was pregnant when I started the program, and so I had to get special permission to go and do it, and she was like, definitely going to do it. It's been an incredible networking opportunity, just like being here, just different. In one of my later mod sessions there on campus, I get a text from my wife that her water broke. So I just hightailed out of class, knocked over a table, caught an Uber, made it down just in time, for my daughter to be born, So that'll always be kind of memorable. Everyone in the class kind of jokingly says that she's like the first AMDP baby, in the class. But it was a great experience, and for me, I'm just always a big proponent of continuous education, and that was an opportunity for me.
Can you give more information on how the franchise model works with a lot of these big hotels? Are they providing you, a lot of infrastructure in terms of running day-to-day operations, or are you just kind of paying for the brand name?
You are paying for the brand name. You're paying for access to their reservation system, meaning that when people go to say Marriott.com to book a hotel, and if you have a hotel that's branded under Marriott, say like our Autograph Collection Hotel in Orlando, and they need to be in Orlando, our hotel will pop up. There's also the technology and marketing that they do at the corporate level that benefits your property that you don't get the benefit of if you don't have that brand alliance. Now, I'll be honest, brands, don't always make sense to have. There are certain markets that being independent works great, like places like, say, Miami Beach. There's no need to really have a brand. Sometimes having a brand can limit how much you can charge because there might be other brands under that same flag. So when I say flag, I'm talking about the parent. So IHG, Hyatt, Hilton, Marriott, for instance. When I say brands, I'm talking about all the different, hotel, all the different chain scales under each flag. So like under Marriott, it'd be like Courtyard, Fairfield Inn, JW Marriott, Autograph Collection, etc. So there are some markets that, being independent actually works well. It resonates more. Sometimes some markets, people don't want to stay at a branded hotel. They want to stay at something unique, boutique, caters to that local submarket. So
And how does the structure work out in terms of the percentage? They
it's
get?
it's a franchise model. I mean, every flag or every brand has like a different. You pay an initial application fee, then you pay like a certain percentage of revenue. So that can vary, from brand to brand, but on average, after it's all said and done, you're probably paying, like around, call it about 10% off top line revenue. Now, it may not be every revenue line item. So like for instance, if you're physically managing the food and beverage, you're not paying a percentage of the food and beverage revenue to them. You're paying, maybe parking revenue, any resort fees you charge, and also top line hotel revenue.
It's kind of a loaded question, so bear with me. Okay, so you talked about acquisition, of the hotels, but you didn't mention disposition. So do you guys plan, do you buy these with the intent of just holding them forever? And then if you do you guys have a certain standard or requirement for occupancy and stability that you look for in the hotels that you're investing in? And if you don't, do you ever revamp them, or do you go with it in the intention of doing value add?
Yeah, no, great question. So every hotel we buy, we always look at it on the disposition front. What would it look like? I mean, we like to see a good chunk of the return come from operating cash flow, so you're not so reliant on just the market taking you higher or just arbitrarily getting a higher valuation for, compared to what you bought it for. But we generally underwrite to about a 5-year period. There's no real science around a 5-year period. I mean, you can't really see too much further than 1 or 2 years, in terms of having some view of the economy. But 10 years is too long. That's kind of arbitrary. That years 6 to 10 don't really mean a whole lot. And you're going to have some kind of disruption in the economy that may, cause that, just to kind of go completely awry. So 5 years is what we underwrite to. We do, I think for hotels, because you don't have these long-term lease structures in place, I think retail, big shopping malls or apartment complexes, I think they're easier to hold longer term because you do have more clarity around what cash flow is going to look like over the next 12 months or even 24 months. For hotels, our view is when we go and buy, we like to be buying with some upside already determined. And we implement on our business plan on how we're going to create that value upside. And then once we stabilize operations, we want to get it back out to market to sell. Because we do structure our deals with outside investor capital. So we want to generate a good return. And we're only as good as what our track record is. So when there is the opportunity to monetize for everybody and deliver a good return, then we want to do that. And a lot of times the investors will just kind of follow us to that next deal.
Satori, do they focus on regional markets, or do you guys go across the U.S. when it comes to hotels?
Well, now since we've kind of adjusted our business model where we can work with any third-party operator, we will look at any market across the U.S. We're currently as far west as Texas. We have looked at stuff in Arizona, Colorado, Utah, California, in the Pacific Northwest, and we just haven't found anything that's made sense. But we will look at any market that has, good underlying dynamics, good growth projections, something happening in that submarket, maybe new development that's coming in. To give you an example, we bought a hotel in Orlando at late 2022, autograph collection. It's called the Castle Hotel, walking distance to the convention center, across the street from Lockheed Martin's regional headquarters. No one likes what's happening in Eastern Europe, with the war and fighting and so forth, but it's good for Lockheed Martin's business. That's where the missile defense technology all happens. So they have scientists and everyone that's coming in to see what's going on there. Their headcount doubled during the course of our due diligence. Also, right across the street is where Epic Universe is being developed. That's a 700 or 750 acre theme park development. At completion, it'll be for Universal Resort. It will increase their footprint by 4 times. It'll be at completion about 5 to 6 times the size of Magic Kingdom. So that's going to be a huge demand generator. And then you also got the airport that's continued to grow. They added Terminal C, which was I think to the tune of over $2 billion. It's got 15 or 16 gates, all international. So we looked at all that, and that's just like an example of what gets excited, about a new acquisition. Plus at the convention center, we saw by meeting with their director of sales that they were on a T12 basis, they were already starting to eclipse pre-pandemic annual attendee highs. So that was pretty spectacular coming out of COVID to see that happening. So that's kind of like all the things that we kind of take into account.
Thank you.
You had a question?
So, like you said, not really exposed to much of the hospitality industry. So if and how does your due diligence and your site visits and your underwriting differ compared to, like you said, with the breadth of multifamily, since the company have locked in rent, since it's like constant change coming in and out of the rooms? How does it differ, if at all?
Well, for us, like on the hospitality front, we're spending a lot of time, at the property level, with like, say, the director of sales, the general manager, understanding what type of business is coming in. We try to understand, what hasn't worked for them. Is there anything by the current ownership that's impeded their ability to grow and to further market the property out to the submarket? We try to understand what is it you would like out of new ownership, to help you do your job better. And it's really focused on the operating business. And then, we will get a bunch of third-party, assessors out to the property to understand the building envelope, understand the roof, understand the elevator systems, any moisture intrusion, utilize different types of technology to understand, especially if it's like on a beachfront property, a lot of salty air, like how does that impact on the systems and the exterior structure. So that's kind of like what's different. It's more focused around the operating business, whereas, on some of the other asset types, you're looking at rent comps, you're looking at quality of construction, you're looking at really that T12, and it's all geared around longer term leases as well. And if like retail, you really focus on when are those leases going to roll, and what does that look like? What are like new rent comps, that have come into the market? Who are new tenants that are coming in? So that's, a little bit different.
Your class is similar to ours regarding that MSRE program, in that the market has changed so much. I want to hear a little bit about what you learned in the program being in a downturn, and also in general what you learned about the recession.
Sure. Man, it was tough. I think I had kind of the benefit of coming into the program with probably more experience than a lot of the students. Our class was a little different. We had about half the class that had maybe coming right out of undergrad, maybe with 1 or 2 years experience, and then we had another swath of my classmates that had at least maybe like 4 or 5 years experience. I came in with almost like about 7 years of experience, like about 6.5. And I just made it a point to get out and meet people in person. For me, real estate is very relationship oriented. I know we got like this remote work and all that's kind of going on right now, but I'm still a big believer in just talking to people in person, getting to know them. And that was part of the reason why I just got in my car and just got out and met as many people as possible. And to get in front of them, understand their businesses. And that's what made sense to me. I've always been kind of like a funnel guy, meaning like the more you stick into the funnel, the more likely someone's going to come out the other end. And that's the way I approached it.
Thank you.
Sure.
I've been seeing some content lately about boutique hotels, and I guess this is like kind of a two-part question. Does Satori at all deal with boutique hotels, or is that kind of too small? And also, I've seen some kind of content on like how there's like a lot of boomer-owned boutique hotels, and now there's going to be this kind of transfer of wealth, so there's an opportunity in the market. So, yeah, it's just like an answer on both of those questions.
Sure. No, boutique. The word boutique kind of like took a life of its own. Like what is boutique? You've got like maybe like a small hotel in like Miami Beach. They just made the lobby white. There's no branding on it. They make it look very modern, but it's very poorly run, and they call it boutique. But there's really no services, no amenities. And then you have some of those that truly are boutique, that are independent. And then now you've gotten the brands because they started to see, because what's changed with traveling experiences, especially like coming out of COVID, is people are looking for something experiential. Whenever they go and travel somewhere, they stay at a hotel, they're very purposeful for the places they go to visit, the hotels they choose to stay. So how can you make your hotel distinct? And so a lot of the brands, or a lot of the flags, they've kind of gotten into the boutique space with what they call soft brands. So that's like, Tapestry and Curio by Hilton, Autograph Collection by Marriott. Starwood really kind of spearheaded that, because a lot of their hotels before they got acquired, was boutique, like the W, the Aloft. They were like kind of like the boutique counterpart to the Westin Hotel, for instance, in the Courtyard. The advantages of boutique is that you're generally, when you compare a boutique property, whether it's soft branded or truly independent, to like a vanilla hard brand, is that you don't have a cap on like what you can charge, because it's more experiential, it's more memorable, and so people are willing to spend for a good experience.
How many acquisition processes do you manage at once, and what's your maximum amount of processes that you can manage?
Yeah, and I mean I would say, we've pursued, at any point in time, 3 or 4 hotels concurrently, but we may have more offers out there, but not all of them will hit, but I would say in reality, I'd say 2 or 3 at a time. And it also depends on how you're kind of capitalizing your deal. We've kind of pivoted, because out of what we needed to do, from institutional to retail. So when we're going to retail and we're going out for like a new acquisition, let's just say it's $50 million of equity, and you're taking out 60% debt, so that's 30 million equity, or 30 million debt, 20 million equity. So we have to be prepared to fund 20 million, 100%, and then can backfill with retail capital, because retail capital, working with high net worth investors, takes longer. You may not have it all lined up by the time that you're ready to close in the acquisition. Whereas if you're dealing with an institution, an institutional group, they will be there when you're ready to close. So you only have to be responsible for, say, if you're doing a 90-10 deal, only 10% of the equity. So I use that example of 50 million, we only have to have 5 million ready. And so that 20 million under the retail strategy that we have to have, we could go after 4 hotels with only 5 million, right? Because 5 times 4 is 20. We could do 4 deals at one time with the amount of capital that we're looking to deploy on one deal, and then backfill and get 15 million back from our retail backfill exercise. So I think that also plays into it. And right now, since we're more retail focused, once the institutions come off the sidelines and we start working with them again, that's going to open us up to be able to look at more opportunities at one time.
So really the only obstacle is money?
No, it's also like your head count, and that's really specific company by company as to how deep they're staffed. I think most private equity, private investment groups tend to be leanly staffed. So I would say, probably like 3 to 4 acquisitions, would be the max that you can do at any point in time. Especially for hotels, because there's so many different intricacies, with the operating side of the business that you have to focus on, and so many different things, like around, like if you're trying to procure like a liquor license, if you have a food and beverage operation, all the licenses that you have to transfer over, those are things that are unique to hospitality, to hotels that you don't have for apartments or for logistics, industrial, etc.
I get a question. What institutional investors have backed off hotels? Is it pension funds? Is it endowments? Is it sovereign wealth? You said that
I don't think it's just hotels. It's across the board. Institutions have put out a lot less money. They've raised a lot of money. There's a lot of dry powder. There's plenty of studies and stats to showcase that. But they've just been, very conservative. Institutions don't tend to be, they don't move in the silo. They wait for someone like a Blackstone or a Starwood to kind of go out and make a big splash, and then everyone kind of follows. You're seeing a lot of the private equity have pivoted from selling equity to buying debt. So where they were LP equity partners, now they're doing more like subordinated financing or even senior financing, where they're trying to manage all aspects of the capital stack on the debt side, because in their view, and it's true, in terms of where we are right now, is that on the debt side, you can kind of get equity-like returns, but you do have a lien on the property, so you are protected more so than you are if you're investing common equity. I do think, though, that they're starting to come off the sidelines, just based on the conversations I have monthly and quarterly with a lot of our, current and past institutional partners. There was a large conference down in Miami, CREFC, and the feedback from that was a lot of the lenders are looking to come out, and you're going to see a lot more participation in 2024 than you did in 2023. Part of that is because they're issuing a record amount of payoffs. And so when they're issuing payoffs, they're freeing up the balance sheet, which allows them to now lend, and they have to lend, right? Because the way the banks make money is the spread between the interest that they pay you on your checking account versus what they're getting on the loan interest. So they have to get money back out there. So we're actually, we've got a project. It's a coastal market in the southeast that we just took under contract, under control and under contract. And we're in the middle of due diligence right now, and it's a heavy renovation play. And we've already gotten a lot of interest on the debt front, which I don't think this time, like last year, we would have. So I think, once, the debt starts coming, I think you'll start to see the institutions start to come out as well.
Mr. Samir,
Mr. Ratner.
it's great seeing you, man.
Same here.
Listen, it's January, these guys are freaking out. Okay, they're gonna get out in May, everybody wants to have jobs, they want U-Hauls ready to go. You, think about it, January 08, around Valentine's Day, a month from now, ballpark. Bear Stearns collapses, right?
Mm-hmm.
Okay. You're still going after jobs. So think about it from their standpoint. You mentioned non-performing notes right now as kind of being something that seems to be leveling up, and that's what we all hear about. Where do they go? What kind of jobs? Where do they get the jobs?
It's a good question, because I was in that position. I didn't have a job in January. I didn't have a job when we actually graduated. I got my offer about a month or two after we graduated. I started the discussions prior to graduation, but I didn't have the offer letter until post-graduation. So one, you just got to stay adamant and keep that funnel full with contacts, people that you're reaching out to. Take every opportunity to job shadow. So one, you're building a relationship, you're providing free work, you're getting experience also along the way. But I would say in terms of where the opportunities are going to be, right now, a lot of if you're interested on the investment side, the equity side may not be, necessarily where there's going to be, right now in terms of, call it the last 6 months, there hasn't been a tremendous amount of activity on the equity side, but there's been a tremendous amount of activity with real estate debt funds, because they pivoted from the equity side to the debt side. Now, they will come back to the equity side when that risk-adjusted return kind of comes back to where it makes sense for them to deploy equity. And so I would say it's like, wherever you're going to go, if you're interested in transactions, which is what I was interested in, wherever you're going to see a lot of deal flow. And it may not be with an equity shop, it could be with like an appraisal firm, where you get to see a lot of different asset types, you get to understand, deal level, property level underwriting, you get to understand cash flow, operating statements. So kind of think a little bit outside, of what you think might be like the sexiest area to be in, and what may historically pay the highest salary. I'll tell you, I came out of the program and I was making half of what I made coming into the program. It all caught up, in that next opportunity that I had. The other thing is, where do you, I like to say, your career, it's more of a marathon. It's a journey. It's not a sprint. And it's also where you, I think I had it on one of the slides, where you start is not where you finish. So don't be overly picky about this isn't like the perfect opportunity, what I came in the program that I was hoping to do. Go somewhere where you've got good people, good mentorship, and where you're going to learn. And at this point, I can honestly say when I came out of undergrad and when I came out of the master's program, it didn't matter what I did in the area of real estate, I was going to learn.
So you said when you acquire hotels, you have in mind how you're going to create value. Now you kind of have your operating side and your renovation side. So like, Is there anything outside of that you're looking for in terms of like how you can create value?
Yeah, I mean, we'll look at like what things have recently traded for, and if there's not a lot of sales activity in that submarket, we'll go pull similar submarkets around the country that exhibit similar kind of dynamics and see what things have traded for there. So to kind of expand and just understand what's our going in basis. Is it reasonable? And then we look at, we can kind of look at an operating, P&L, a profit loss statement for how the hotel's done on a T12 basis and look through. We can compare it to our existing portfolio if it's like, a brand that we already currently own, and look at it and just see what looks out of whack. Is the room's expense at like 35%? Maybe it shouldn't be higher than 20%. What's happening here? Let's dig in deeper. Are they employing a lot of, is there a lot of fat there? And a lot of hotels could be like owner-operators, where they could have could be like other family members, it could be like overly staffed, so we kind of look at that. We also kind of look at, on your uncontrollable expenses, so like around taxes and insurance. That's a big thing, especially in coastal markets and especially in Florida. And, we work with, like for instance, one of the advisory board members, Todd Jones. We work with his firm a lot. Once we know that a deal has legs under it, we go to him and, his team, they'll look at, in terms of the property, the purchase price allocation, kind of splitting out real property value, and see where we can get really efficient with what the operating taxes are going to be, going forward. Same thing when we're selling. That same analysis helps us on transfer taxes when we're selling the property. So I bring him in on every deal that, makes sense, like once we know we're going to move forward on it. So those are things that we look at, in terms of like how we can kind of create value. And it's also like the existing brand that's in place. We always look at, is that the right brand? Is there another brand? Maybe that makes more sense. Should it be independent? So those are all the discussions that we have internally.
This may be a dumb question, but speaking of brands, do some of these large companies like Marriott, Hilton, Hyatt, if you have an investment or operation with one of those flags, will they hesitate to work with you because that's one of their enemies?
No.
You have Marriott and then Hyatt might not want to work with you.
Yeah, obviously if you have like in your portfolio, if it's heavily skewed towards one or the other, like if you have just more like Hilton properties, you're generally going to get more love from Hilton on that next opportunity. Likewise, if you have a lot, for, like very much skewed towards Marriott, and now you're looking to do your first deal with Hilton, they may see it as an opportunity because clearly you've exhibited a good track record and you've been very focused on one other brand or one other flag, and now they see an opportunity for future pipeline. But generally, a lot of groups, they'll have hotels across multiple flags and brands, so that doesn't really come into play too much. It's where you don't have any representation, and maybe all of your hotels are on the lower end of the chain scale, and you're looking to move up. That requires a lot more due diligence in terms of you as an operator, you as a sponsor, what's your track record, before they're willing to kind of bet on you.
I was wondering if the advent of Airbnb and VRBO and those types of services has impacted your guys' business plan at all, and if not, I was wondering if there was maybe any interesting ways that the industry is, connecting.
Yeah, it's definitely had an impact on it because it's another kind of shadow inventory of hotel rooms, effectively. I think what's also happened over time is Airbnb has really kind of filled a void where the hotels just don't have a presence. Also, if you're traveling in like larger groups, like families, where everyone kind of wants to be staying together, if it's like, like a family get together, so it's like a larger group than just like 2 or 3 people traveling together, an Airbnb can make more sense. But you're also seeing the brands have kind of moved into that, like Marriott has moved into that space to where they have like their home villas that you can rent. That's very similar to like a Airbnb business plan, and the way they market themselves is, it's like Airbnb, but you get the trust and the consistency of the Marriott brand. That's what they kind of put out there.
how do you go about selecting a franchisor? Do you go with whoever gives you the better deal, or whoever is better for the property itself?
Well, I mean, ultimately it comes down to what's best for the property. But we'll also look at who has the most brand representation. If a market is like very heavily saturated with Marriott and Hilton, you may not want to get another property that's Marriott and Hilton, because you're just going to be competing with all the other brands that are already there for business. When someone wants to stay at a Marriott property, now they have a choice of another hotel. So it's hard for you to differentiate. Whereas if, say, you're the only Hyatt property or the only IHG property in the submarket, now you get the advantage of the entire loyalty membership base under that flag. And now anyone that's looking to book an IHG hotel because that's who they're loyal to and they're going to XYZ market and you're the only hotel, guess what? You're going to get that business, every single time. So it really depends on, we do a deep dive on market segmentation, who's currently represented, and see what would be the available brands. Like what's the ideal type of brand and what's available.
Kind of follow up to that segmentation. Like I see hospitality is like a pretty big bucket, right? But then within it you have all the different flags. Do you kind of hedge? Like I imagine like the Four Seasons, for example, is a lot more recession proof than, I don't know, like a Hyatt. Do you kind of hedge within the brands, like the segments?
Yeah. I mean, we kind of know, like we have like the range of chain scales that we focus on, from like select service to extended stay to compact full service. So we'll look at everything kind of under those umbrellas. We won't go after like big resort properties or big convention style hotels. Those hotels, they tend to, all the ancillary revenue tends to outstrip room revenue. It can be like double the amount. And then you're really like in the retail business. You're not in the hotel business. It's like a Vegas, I was telling like the roundtable discussion we had earlier. Like a Vegas hotel, they don't really care so much about the room, what their occupancy is. If someone's spending a lot of money at the tables, they'll just give them a room for free, right? So it's a different business model. In terms of balancing our portfolio, we do, look at, some hotels that provide good, consistent cash flow, dividends, for our investors, and balance that with kind of like true value add, where there's going to be heavy renovation, the hotel's going to be offline for a period of time, there won't be any distributions, but then when it comes back, it'll come into the marketplace bigger and better than it was before. So you'll kind of make up that difference. So, we try not to be all or one. Any other questions? I'm here for you, so any questions you have.
One more. Where are you guys primarily sourcing debt nowadays? Are you approaching family offices, banks?
I mean, we generally reach out, we'll reach out to everyone, just to get a full, just market-wide approach, cast a wide net. But right now, it's the real estate debt funds that are the most attractive and flexible structures. CMBS is still out there, but they have very hefty prepayment penalties. And then the regional national banks are relatively quiet right now. That can all change, but right now it's the real estate debt funds that are the most active.
Other questions? Okay, let's give him a round of applause.